In this video, we'll show you 3 powerful growth stocks you can buy with just $250 right now that could quietly compound into something much bigger over time. These are dominant businesses operating at massive scale, embedded deeply into the infrastructure of modern digital life, with durable competitive advantages that make them extremely hard to replace. And by the end of this video, you'll understand not just what they do, but why they could continue growing for years while most investors are still focused on the wrong opportunities. Now here's the reality most people miss. You do not need thousands of dollars to start building real wealth in the stock market. What you need is access to the right businesses early enough and the patience to let them compound. So let's get straight into it. The first company is Palo Alto Networks, ticker symbol PANW. Before we even talk about numbers, you need to understand why this business matters, because cybersecurity is no longer optional. Every company, every government, every financial institution, and every digital platform is under constant threat. And as more of the world moves online, the attack surface continues to expand. This is not a temporary trend. This is a permanent shift, and Palo Alto Networks sits right at the center of it. What makes this company so powerful is not just that it offers cybersecurity solutions, but that it has built an entire ecosystem around protecting digital infrastructure across networks, cloud environments, and endpoints. This is critical, because most companies do not want to manage multiple vendors for security. They want a unified platform that can handle everything, and Palo Alto has positioned itself as exactly that. Now here is where things get interesting from a business standpoint. Palo Alto Networks has been aggressively shifting toward a platform-based model, consolidating multiple security functions into a single integrated offering. This creates a strong moat, because once a company integrates deeply into your systems, switching becomes difficult and costly. That means high retention, that means predictable revenue, and that means long-term compounding. Now let's talk about growth. According to the data referenced, Palo Alto continues to deliver strong revenue growth while expanding its next-generation security platforms, particularly in cloud security and AI-driven threat detection. This is where the future is heading. As more workloads move to the cloud, the need for advanced, scalable security solutions increases dramatically. And Palo Alto is already there, not trying to catch up, already there. Now here is another key point that most investors overlook. This company is not just growing, it is becoming more efficient. It has been improving margins while continuing to expand its customer base and product adoption. That combination is extremely powerful, because when a company can grow revenue and expand profitability at the same time, it creates a compounding effect on earnings. And over the long term, earnings drive stock prices. Now I want you to think about the long-term relevance here. Cybersecurity is not going away. If anything, it is becoming more critical every single year, and companies like Palo Alto Networks are not just participants in this trend, they are leaders, which means they are likely to capture a significant portion of that growth. But here is the part that should really get your attention. Even though this is a large, established company, it still has a long runway ahead, because the total addressable market for cybersecurity continues to expand. New threats, new technologies, new vulnerabilities, all of that creates ongoing demand, and Palo Alto is positioned to capture it. Now let me give you my take. This is the kind of company you buy not because it will double overnight, but because it can steadily compound over time. And when you are starting with a small amount like $250, that kind of consistency matters more than short-term spikes, because compounding is what turns small investments into meaningful wealth. Now here is something else to consider. As artificial intelligence becomes more integrated into business operations, cybersecurity becomes even more important, because AI systems themselves can be targets, and they can also be used to launch more sophisticated attacks. So the demand for advanced security solutions is only going to increase, and companies like Palo Alto are already building capabilities in that space. So you are not just investing in today's business, you are investing in where the industry is going, and that is a key difference. Before we move on, I want you to ask yourself something. How many industries can you think of that are guaranteed to grow over the next decade? Not maybe grow. Guaranteed to grow. Cybersecurity is one of them, and owning a leader in that space gives you exposure to that growth. Now, if this resonates with you, you're exactly who this channel is for. People who are ready to stop losing money in the market and take their investment portfolio to the next level. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's move on to the second company. ServiceNow, ticker symbol NOW. This is one of those businesses that most people have heard of, but very few truly understand, and that creates opportunity. Because when you understand what a company actually does and why it matters, you gain an edge. ServiceNow operates in the enterprise software space, but not in the way most people think. This is not just another software company. This is a platform that helps organizations automate workflows across their entire business. Think about that for a second. Every large company has processes: HR, IT, customer service, operations, finance. All of these functions rely on workflows, and traditionally, those workflows have been fragmented, inefficient, and difficult to manage. ServiceNow changes that. It provides a unified platform that allows companies to digitize and automate these processes, which leads to increased efficiency, lower costs, and better outcomes. And here is the key. Once a company builds its operations on ServiceNow, it becomes deeply embedded. This is not something you switch out easily. This creates a very strong competitive moat, because switching costs are high, and that leads to high retention rates. Let's talk about growth. ServiceNow has consistently delivered strong revenue growth driven by increasing demand for digital transformation. Companies are not just adopting technology, they are restructuring how they operate, and ServiceNow is right at the center of that shift. Now here is where things get even more interesting. The company is expanding into AI-driven workflows, which means it is not just automating processes, it is making them smarter. This increases the value of the platform, and it strengthens the company's position in the market. Think about the long-term implications. As businesses become more complex, the need for efficient, automated workflows becomes even more critical. And ServiceNow is one of the few companies that can deliver that at scale, which gives it a significant advantage. From a financial standpoint, the company has been delivering strong subscription-based revenue growth. This is important, because subscription revenue is predictable. It creates stability, and it supports long-term planning and investment. And when you combine that with high customer retention and expanding product adoption, you get a business that can compound over time. Here is my perspective. ServiceNow is not a flashy company. It is not something that dominates headlines, but it is incredibly important, because it sits behind the scenes, powering the operations of some of the largest organizations in the world, and that kind of positioning creates durability. Before we continue, I want you to consider this. How many companies can you think of that are deeply embedded in the operations of thousands of businesses, generating recurring revenue and expanding their capabilities through AI? That is a powerful combination, and it is one that can drive long-term growth. What makes ServiceNow different is not just what it does, but how deeply it integrates into the core operations of businesses. This is not a tool that sits on the side. This becomes part of the backbone of how companies run. And when software becomes part of your operational backbone, it becomes extremely difficult to replace. That is where the real moat comes from. Here is something important that was highlighted in the data. ServiceNow has continued to expand its platform across multiple use cases, not just IT workflows, but also customer service, HR, and increasingly broader enterprise automation. This is key, because it means the company is not limited to a single vertical. It is expanding horizontally across organizations, and every new module increases switching costs even further. Think about what that does to revenue. You are not just acquiring customers, you are expanding revenue per customer, and that is one of the most powerful growth drivers any business can have, because it is much easier to sell more to an existing customer than to acquire a new one. Now let's talk about scale. ServiceNow is operating at a level where it is serving some of the largest enterprises in the world. These are not small contracts. These are long-term, high-value relationships, and that creates a level of stability that most growth companies do not have. Here is where I want to insert a key insight. A lot of investors chase growth without understanding quality, but the best investments are not just growing fast, they are growing in a way that is sustainable, and ServiceNow is a perfect example of that. Recurring revenue, high retention, expanding use cases, and increasing importance within customer organizations. That is what sustainable growth looks like. Now let's connect this to the bigger trend. Digital transformation is still in the early innings. Yes, companies have been adopting technology for years, but most organizations are still far from fully optimized. There are still inefficiencies, still manual processes, still disconnected systems, and that creates ongoing demand for platforms like ServiceNow. Here is another important point. As artificial intelligence becomes more integrated into business processes, the value of platforms like ServiceNow increases, because AI needs structured workflows to operate effectively, and ServiceNow provides that structure. So you are not just investing in workflow automation, you are investing in the foundation for AI-driven operations, and that is a much bigger opportunity. From a financial perspective, the company has been delivering strong subscription revenue growth, with high visibility into future earnings. This kind of predictability is rare in growth companies, and it allows management to invest aggressively in innovation while maintaining financial discipline. Here is my take. ServiceNow is one of those companies that can quietly compound for years without attracting too much attention from retail investors. And those are often the best opportunities. Because by the time everyone starts talking about them, a lot of the upside has already been realized. Let me ask you something. Would you rather invest in a company that depends on constant hype, or one that is quietly becoming more essential every year? That is the difference. Before we move on to the third stock, let's talk about something that can help you take advantage of opportunities like this on a deeper level. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Let's move on to the third company, Flutter Entertainment, ticker symbol FLUT. This one is very different from the first two, but that is exactly why it is interesting. Because while Palo Alto Networks and ServiceNow operate in infrastructure and enterprise software, Flutter operates in the consumer space, specifically online sports betting and gaming. Before you dismiss this as just another entertainment company, you need to understand what is really happening here. The global betting industry is undergoing a massive transformation. It is moving from physical locations to digital platforms, and this shift is still in progress, which means there is still a lot of growth ahead. Flutter Entertainment is one of the largest players in this space, and it has built a portfolio of brands that operate across multiple markets. This gives it scale, and scale matters, because in this industry, customer acquisition is expensive, and companies with larger platforms can spread those costs more effectively. Here is where the competitive advantage comes in. Flutter has been able to leverage its size to improve profitability over time. It is not just growing, it is becoming more efficient. And that is critical, because in industries like this, where competition is high, efficiency can be the difference between long-term success and failure. Now let's talk about growth drivers. The continued legalization of sports betting in different regions creates new opportunities for expansion. As more markets open up, companies like Flutter can enter and capture market share. And because they already have experience in infrastructure, they can scale quickly. Here's another key point. Digital platforms allow for better data collection and personalization, which means companies can optimize user engagement and increase lifetime value. And Flutter is leveraging that. Think about what that means over time: higher engagement, higher retention, and more revenue per user. That is a powerful combination. Now, from a financial perspective, the company has been growing revenue while improving its path to profitability, particularly in key markets like the United States. This is important, because the US market is one of the largest opportunities in this space. And as the company continues to scale, margins are expected to improve. Here is my perspective. Flutter is a higher risk, higher reward type of investment compared to the first two. But it also offers exposure to a different kind of growth. Consumer-driven growth, which can be very powerful when executed well. Now let me ask you this. How many industries do you know that are still in the early stages of digital transformation, with expanding legal frameworks and growing user adoption? That is the opportunity here. Now, as we bring everything together, I want you to think about what these three companies represent. They are not random picks. They each tap into major long-term trends: cybersecurity, enterprise automation, digital consumer platforms. These are not short-term themes. These are structural shifts. And when you invest in companies that are aligned with structural shifts, you give yourself the best chance of long-term success. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now here is a question I want you to think about, and I want you to drop your answer in the comments. Which of these three businesses do you think has the strongest long-term competitive advantage, and which one do you believe has the biggest upside over the next decade? Because the answer to that question can shape how you build your portfolio. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.